We are diving immediately into a high-level analysis report on DataVault AI. That's ticker DVLT. It argues a recent 6% drop is a, quote, golden buying opportunity. And what jumps out right away is just how clear that thesis is. I mean, it hooks you immediately. The whole thing is built around this huge gap between the current 75-cent price and the $3 analyst target.
That clarity is definitely a strength. But, if that 300% gap is the main pillar, we have to make sure that pillar is actually structurally sound. And that's the first place this report could be so much stronger.
I noticed that. The analysis relies pretty heavily on that external validation to bridge the gap.
The analysis relies too heavily on the analyst consensus price target of $3, without internally constructing a proprietary valuation pathway to justify that massive gap. That's the foundational weakness. The analysis needs to show its own math, its own conviction.
Right, because the report keeps coming back to that $3 target. It's the primary proof point for the whole upside.
Exactly. And the weakness is that if you actually look at the fundamental data they provide, I think it was $6 million in trailing 12-month revenue, it just doesn't give you a clear roadmap. How do you get from 75 cents to $3? The report just presents that target as a fact, almost outsourcing the hard work to Wall Street, instead of building the case internally for why the market should eventually agree with that valuation.
That's the difference between just having an opinion and having a rigorously supported model. For sure. But, is there a risk there if they spend too much time justifying the consensus target? Do they lose that immediate hook that's so powerful?
It's a balance. The suggestion here isn't to abandon the target, but to shift the focus from simply citing it to actually validating it. And that validation has to come from translating the company's future catalysts, the IP monetization, this data score thing, into actual quantifiable projections for revenue or assets.
Okay, so let's think about that. They're trading at what? A $30 million market cap with $6 million in revenue. That's a price-to-sales multiple of about 5.
Right.
To hit a $3 target, you're talking about a market cap closer to $120 million. That would require a price-to-sales multiple of 20, maybe even 30 if revenue only grows a bit. That is a huge leap.
That's it, exactly. That is the gap you have to explain with math. The person reading this needs to see the bridge that explains how you get that kind of multiple expansion. And there are a few concrete ways to do this. For example, one approach is just detailed financial modeling. Build a projected revenue model for 2025, maybe 2026, and explicitly link the success of DataScore to those numbers. Show how that growth justifies a higher price-to-sales multiple. You could even benchmark it against other high-growth AI firms that trade at, say, 25 or 30 times forward revenue. That model then becomes your own proprietary reason for believing in that $3 target.
Yeah, that gives the investor something tangible, something they can track. You also mentioned comparative analysis.
Yes, but it has to be a really surgical comparative analysis. Don't just pick any successful AI company. You need to benchmark DVLT's situation, this whole IP and restructuring story, against similar successful pivot companies.
Oh, that's smart.
Yeah, find companies that were maybe distressed assets, trading under $1, that used a specific IP catalyst to justify a huge re-rating. That shows that this kind of turnaround has a precedent, that the mechanics have worked before in this sector.
That kind of detail transforms the whole piece. It shows that hitting $3 is a mathematical exercise, not just a hope. It takes the analysis of the current 75-cent price, which, let's be honest, reflects its history as a struggling penny stock, and turns it into a clear roadmap of what metrics need to change.
Precisely. And that mathematical exercise is only as good as its inputs. Which brings us right to the source of all that future growth, DataScore. And that's where this analysis really needs more muscle.
Okay, so the current report introduces this pivot to AI data valuation and this DataScore technology as the main reason for future success.
The report introduces the crucial pivot to AI data valuation and the DataScore technology as the primary justification for future success, yet leaves this key catalyst largely undefined and unsupported by technical detail. The entire bullish case hangs on this one thing, and we're left with more questions and answers about what it even is.
The report is good at identifying that the company's valuation hinges on its new IP. It uses that strong line, data is the new oil.
And that's a great high-level hook, but the analysis just stops there. That's the weakness. There's this huge lack of detail about what DataScore actually does, what stage of development it's in, what problem it solves better than anyone else, or what its monetization plan looks like. I mean, if this IP is the engine for a 300% gain, you can't just leave it as a black box. This vacuum of information makes the whole thesis feel speculative, not analytical.
I agree. That connection between the tech pivot and the valuation jump needs to be way stronger. But I'll play devil's advocate for a second. With a fast-moving technology, especially IP that might still be in development, is there a risk that detailing it too much could expose them or make it look like vaporware if the details aren't totally locked down?
That's a fair concern, but for a high-risk, high-reward call like this, the responsibility is on the analysis to build that rigor. Since the whole case rests on this tech, the report has to dedicate real space to explaining the IP's core mechanism and its market opportunity. It doesn't need to give away the secret sauce, but it absolutely needs to sell the value proposition. So for some concrete examples of how to do that, you could start with a brief, clear section outlining the specific market niche that DataScore is targeting. Is it for enterprise data compliance, real-time data scoring for traders? And then you estimate the total addressable market, the TAM, for that specific segment. That instantly puts a ceiling on the potential growth you're modeling for that 20 times PS multiple.
And defining the TAM gives you that crucial top-down context for the aggressive price target we were just talking about. Without it, the numbers just feel arbitrary.
Absolutely. And then, a truly rigorous analysis has to talk about risk. You have to outline the specific risks of this pivot. What are the regulatory hurdles around data governance? Who are the big, powerful competitors that could just crush them? Addressing the counterarguments head-on actually strengthens the report's credibility. It shows you've done the due diligence.
Yeah. Ignoring those risks makes the conviction feel a bit naive. Addressing them shows sophistication.
And one last thing here. Specifically define what gains traction actually means for DataScore. Investors need measurable KPIs to track. What are the early adoption metrics or pilot programs they should be looking for over the next couple of quarters to know the thesis is on track? If traction is the trigger for the re-rating, you have to give them a map.
That turns the report from just a recommendation into, like, a real-time monitoring tool. Okay, so we've established the need for financial rigor and technical detail. Now let's talk about the packaging. The way it's all presented seems like the final hurdle to maximizing its impact.
This report has this undeniable high-octane energy, which is a strength that grabs your attention. But that energy has to be channeled really carefully.
The intended contrarian, high-energy tone, while highly engaging, introduces subjective and aggressive phrasing that detracts from the material's perceived objectivity as a formal analysis report.
That's the core tension, right there. You see phrases like panic sell, shaking out the weak hands, smart money starts paying attention, and saying the 75-cent price will look like a joke in hindsight. And while that style is great for building suspense, the weakness is that this intense emotional language really undermines the report's credibility for anyone looking for balanced, evidence-based analysis. It starts to sound more like biased promotion than a reasoned calculation of risk and reward.
Yeah, the target audience here is likely pretty sophisticated. They want strategic insight, not just hype.
Exactly. So the suggestion is to keep the strong conviction of the thesis, but just refine the language. Rely on measured observations of market behavior and calculated risk assessment. Shift from sensationalism to strategic insight. Let the facts, the 300% gap, the tech breakthroughs, be the driving force, not the emotion. So for some actionable examples, instead of saying most people see this in panic sell, you can frame that volatility objectively. Rephrase it as something like, the 6% intraday volatility likely reflects short-term profit-taking rather than a fundamental shift, thereby creating a favorable entry point for strategic investors.
That works. It keeps the bullish idea, the favorable entry point, but it uses language that implies careful analysis, not an emotional reaction. It's a calculated take.
Precisely. Also, look at the sign-off language. The current conclusion has very promotional phrasing, like, the red days are where the money is made, folks. That needs to be replaced with a succinct, objective summary that reinforces the actual strategy.
Maybe something that uses the technical data points they already have.
Yes. Replace that promotional sign-off with something focused and measurable. For instance, maintaining vigilance at the critical 72-cent support level remains essential for validating the immediate buy-the-dip thesis, establishing a strong risk-reward profile at this juncture.
That's much stronger. It's using the hard data, the 72-cent support, the 87-cent target, to create the urgency instead of just relying on generalized hype.
And that applies to that whole technical section. It has to be presented with the same factual, unbiased language. The technical analysis is often the most grounded part of these reports, and in its objective tone should really set the standard for the entire piece.
Refocusing the language really elevates the whole submission without losing that aggressive core thesis. It's trading short-term excitement for long-term analytical rigor. This has been an incredibly